Welcome to this educational module that at a high level answers the question, what is managed futures? In this module we're going to cover where the investment takes place, what asset classes are invested in. We're going to talk about the contract structure, its long and short nature. We're also going to talk about the primary strategies. And the strategies are important because they speak to how and when the investments are made, and they also speak to the performance drivers, those factors that generate returns, both positive and negative. We're going to talk about how investors access the investment through a direct account or a fund account, and then we're going to talk about the regulation and the investor protections. Speaking of investor protections, you have on the screen a risk disclosure. As you may know, managed futures is a highly regulated investment. Please read the risk disclosure and read Chapter 11 that outlines the 3 primary risk choke points in managed futures. If you'd like, you can stop this presentation right now to review the risk disclosure, and then we'll also put it up at the end of the presentation. So let's get into this. What is managed futures? Managed futures are investments in money managers. These people make decisions to buy or sell derivatives primarily in 4 major asset classes: stocks, currencies, interest rate products, and commodities. The core medium utilized is a futures and options contract. While this may sound a little complicated, a futures contract is simply the right to buy or sell something today and take or make delivery in the future. An options contract, as the name implies, gives the buyer the right, but importantly not the obligation, to purchase something in the future. So how did this all begin? The futures and options markets have existed since 1697 as a method for farmers and producers to lock in prices and manage their risk. It's interesting to note that managed futures, at the end of the day, is really a risk management tool from an industry that's all about risk management. So how does it work? In order to make their investment decisions, managed futures investment managers follow what's known as a strategy. You can read more about this on page 80. I'm going to get into it in more detail when I talk about how performance is generated. But for now, I'm going to give a very high-level overview of the strategies. A strategy determines how and when a decision to trade is made. There are 4 primary strategies with many sub-strategies and different flavors of each strategy, but the strategies are primarily defined by their performance drivers. There's trend following, spread arbitrage, option strategies, and discretionary strategies. Trend following identifies a price trend and then buys or sells in the direction of that trend. Typically, trend following is also referred to as systematic trading, and it involves computer-based mathematical formulas that determine when trades should be made. Then there's spread arbitrage, which is essentially buying one product at a potentially lower price and selling a related product at a higher price. For instance, the spread arbitrator might be buying oil and selling gasoline. There are option strategies, both short and long. The long strategies, again, give the investor the right but not the obligation to buy something in the future, and for this right, they pay a premium to the option seller. Then there are discretionary strategies that are often a combination of some of the different strategies and involve human decision-making on a typical basis. Again, we're going to talk about these strategies in much more detail in the module on how performance is generated, and then read chapter 4 in the book, page 83. It gives you some good detail. Okay, how is managed futures regulated, and how is the investment facilitated? That's what we're going to cover next. Managed futures is a highly regulated industry, and there are 2 account types. There's a direct account and a fund account. And there are some pros and cons of each. I'm going to give a high-level overview, but go to page 83 for a much more detailed overview. The direct account is facilitated by a futures commission merchant known as an FCM and their sales partner, the introducing broker known as the IB. Some equity brokerage firms and financial advisors offer direct accounts, and this is unique, but there aren't many financial advisors that offer direct accounts. In order to offer a direct account, a financial advisor has to become an introducing broker. The benefit of a direct account is that it features some investor protections such as transparency and some account segregation that limits the trader's ability to manipulate investment capital, as was done with Bernie Madoff. Performance of direct accounts can also be higher than performance of fund-to-fund accounts, for instance. The disadvantage is that typically investors don't really know FCMs like they would potentially know financial advisors, who are often household names, and then they have to manage a margin account. I detail this again in Chapter 4 in the book. A fund account is easily accessible through a financial advisor. That's really one of the primary benefits. The fund manager manages the margin, and they're the manager of managers, but they also take an additional incentive fee on top of the incentive fees for the other CTAs in the fund. Funds can offer significant diversification and knowledgeable oversight for a smaller investment minimum than a direct account. And funds generally don't offer the same transparency or investor protections that a direct account offers. So these are the pros and cons of a direct account and a fund account. So how is the industry regulated? Well, Chapter 5 talks to industry regulation in great detail, but really at the bottom line there are 2 points. First off, the industry is regulated by the National Futures Association, the NFA, and the Commodity Futures Trading Commission, the CFTC. And one of the key points I want to make is the NFA audits the performance of all investment managers who are members of the NFA, and then they check the performance that the manager reports to the reporting databases such as Barclays or the Altegris 40, the leading indexes that report performance. So that's a basic rundown of the industry, and to recap, essentially managed futures typically covers 4 asset classes. It goes long or short. It has 4 primary strategies. The strategies are very important, particularly as they speak to performance drivers. The industry is accessed through a direct account or a fund account, and it's regulated by the NFA and the CFTC. If you have any questions, you can email me at info@gotomanagedfutures.com. If you are ready to go to the next question, you can click Go to Next Question below, and it'll ask you a question and give you potential educational information. If you feel that you understand managed futures, you understand the risk and reward, you want to go right to get in a recommendation, you can click the button below that says Understand. We now have the risk disclosure on the screen, and it's important to note that past performance is not indicative of future results. Managed futures may not be right for everyone. It can be a volatile investment. The presentation represents opinions. They are solely the opinions of the author. They may not be appropriate for all investors. If you'd like to read this risk disclosure, you can press the stop button and read the risk disclosure. And again, if you have any questions, feel free to email me at info@gotomanagedfutures.com. Thanks for listening, and I hope this has been helpful.